Hello everyone. Today on the Final Bar, I'll be talking with Danielle Shay of Simpler Trading here in our studio in Redmond, Washington. We'll talk about this market really rolling over into the close, but some of the larger themes that have been at work for quite some time here. The strength in consumer staples, some of the weakness in consumer discretionary. Where do we see some opportunities across that space? Ladies and gentlemen, this is the Final Bar. Hello everyone, welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of technical analysis. The technical toolkit I was taught early on is a way to get inside the heads of other investors, to understand their motivation and how that is manifested, right? Their emotional state in terms of fear and greed, the supply and demand, sort of the structural nature of the market. All of that nets out into price. And by analyzing prices over time, by focusing on the message of price, trend, momentum, and also things like breadth and sentiment, we can draw a little deeper conclusions about what is motivating those buyers and sellers and where we may see some opportunities when those conditions shift. With that as a setup, let's get to our market recap. Let's talk about what's actually happened in the market today. Kind of a rollover day going into the close as classic Final Bar sort of setup here. The market looks a certain way, and then just when we start prepping for the show, things all of a sudden take a dramatic turn. But let's talk about how things netted out. You can see the little preview chart on the left, what happened going into the close. There's a headline right before the close, last 10 minutes, with President Biden actually cutting his trip to Asia short, coming back to the U.S. to work on the debt ceiling crisis. I think that might have been a part of that sort of rotation lower. We'll have to see as the dust sort of settles on the close. But overall, the S&P finishing lower about 2/3%, and a lot of that came right in the last 20 minutes of trading or so. S&P finishing just below 4110. So again, still well below that 4,200 level, those February highs, well below resistance, but still holding 4,100, right? So even on a rollover day like today ended up being, still not horrible, right? We're still not too far off of the highs for the year. The Dow leading the way lower, about 1% lower. The NASDAQ was in the green up until the last couple seconds. I sort of watched this number get less and less green and then switch into the red. Down about 0.2%, so not a bad day. And the NASDAQ 100 actually finished just narrowly in the green. Worth noting that mid caps and small caps led the way lower. In a moment, we'll talk about some of the sectors really dragging the performance down a little more, a little magnified in the small and mid cap space. They have a broader representation there than in our large cap benchmarks. The VIX, by the way, moving higher by over a point, up above 18 now to 1824. That low VIX has been one of the sort of, I guess, great descriptive illustrations of this market. The market's sort of stagnant, right? Sort of sideways choppy. A limited number of names, of course. The Alphabets and Meta's doing just fine, but the average stock's sort of flat to down during this period. But the volatility's remained fairly low as a lot of stocks are sort of treading water and waiting to see which way they net out. And break out of this recent range. But volatility increasing today. That might be a really important signal to be watching going forward. Let's look at some other asset classes here very quickly. Looking at interest rates, the whole yield curve from the short end to the long end, all sort of drifting higher. So the 10-year point, which is where we tend to focus the most of our attention, around 355. The long bond yield around 387. Short-term yields, of course, still pretty high. That creates that inverted yield curve we've been talking about for quite some time, with the short end of the yield curve higher than the longer end. Bond prices, of course, moving lower, which is what you would have when interest rates are moving higher. Sort of the inverse of that are bond prices. So the TLT was down about 0.3%. The dollar index, not a huge up day, but we are tracking that rotation higher in the dollar. One of the reasons, if not the main reason, why risk assets have been doing okay at worst in 2023 has been the dollar remaining relatively weak. If you look at the last week, you're actually starting to see the dollar index rotate higher a little bit. So the UUP was up about 0.25% from yesterday's close. Commodities sort of got worse as the day went on. A big sell-off earlier in the morning, from gold and silver, the precious metals, but also other things like base metals like copper, elsewhere, soft commodities like corn, for example. Going into the close, another sort of rollover as the equity markets rolled over. Gold and silver both down over 1%. Silver, the SLV, down about 1.3%. And again, gold has arguably been one of the better charts year to date in 2023. Outside of sort of mega cap tech, you're looking at things like home builders, semiconductors, that's sort of still in that tech space. But gold has been a really interesting sort of outlier from the rest of the market that's been struggling. But gold price is coming down quite a bit here just this week. Finally, cryptocurrencies again rolling over going into the close, but Bitcoin still down just about 0.9%. Ether flat from where we were yesterday. Worth noting, Bitcoin just dipping below 27,000 as we're broadcasting our show just after 4 p.m. Eastern time. Let's look at the 11 S&P sectors briefly, and then we'll just go through a bunch of charts to finish off our market recap. Boy, technology just holding on, grasping to a little color green here going into the close, still finishing up about 0.1%, but it was up a lot more earlier in the day. A lot of that deterioration just came right into the close. Everything else finished in the red, and some of the weaker sectors really had a down day of it, right? Real estate down 2.7%. Energy, the XLE, down 2.5%. Utilities down 2.2%. So you have this situation where very few sectors are actually in the positive. Technology, communication services, basically flat from yesterday's close. On the downside, you have some of the defensive sectors like REITs, utilities, but also energy down over in some cases, 2.5%. Let's check in on a daily chart of the S&P 500 and just see how today's move fits into the big picture. So again, it felt like a huge sell-off going into the close, which again, it certainly did rotate very, very quickly. But again, we're still sort of in that range. I always, there's a reason why this show is called The Final Bar, and it's because we look at the final bar. I always taught new analysts when I was teaching technical analysts at Fidelity for the junior analysts, or at the college level when I was an adjunct professor, I would talk about the final bar. Start with the current bar and then look to the left, because a lot of times newer analysts would their eyes would be drifting all over the place, and I would have to focus them on one point and then sort of build the story from there. So we would always start with the final bar and then go left from there. And if you look at where we're at relative to where we've been, we're literally, look at how many times, how many price bars have overlapped today's range. And it's quite a few just in the last 6 weeks, but certainly in the last 6 months to 12 months. Look at how many times we've hit this point. This is what a bottoming phase arguably looks like. And again, I still think we could have some backing and filling before all is said and done during this period. Worth noting, May is actually seasonally one of the weaker months of the 12. And you can see we've of course had sort of a choppy go of it after April finished a little bit strong, but again was pretty choppy for the majority of it. So the question is what's actionable, and I would argue it's when we break out of this range. Which of these things is going to happen first? Do we get above S&P 4,200, in which case that would be a new high for the year? That certainly could indicate a likelihood for further upside, at least to the August highs of last year around 4,300, if not further. You've seen that breakout in some of the mega cap FANG stocks. In the NASDAQ Composite, of course, has already done that, and other individual groups and sectors as well. The downside risk, of course, is we break below this blue shaded area. It's just around 4050 to 4100. We're not too far from that area. We could get there as early as tomorrow, of course, if we would open lower. That breaking below 4050 would take us below those recent swing lows from April and May. It would take us below the 50-day moving average, which we've been above since the end of March. So I talk about a change of character to the downside. That would be it. With all of that as a setup, the RSI is almost exactly to the penny at 50, which is the definition of a market in equilibrium, right? An equal strength from up days and down days. So very close, and interesting how the S&P is really settling into this range. The question is, what's the catalyst to break us out? We haven't certainly seen that yet. I wanted to share this chart with you too. I feel like as we continue to reinforce this message of, sort of the haves and the have-nots, the mega cap names doing quite well, these smaller mid cap names certainly struggling. And I keep trying to come up with different visualizations to sort of tell this story and illustrate that spread between the two. I just came up with this basic idea of overlapping these two charts, or overlaying these two charts. We have the Russell 1000 ETF in black and the Russell 2000 ETF, the IWM, in green. So it's basically large caps in black, small caps in green. Look at how closely these two data series matched each other. I mean, very, very close up until about 6 to 8 weeks ago. And then look at this dispersion between the two, right? From the February high, they both sold off. Then all of a sudden, large caps have recovered largely very, very well and are still retesting the February high, whereas small caps are well below that February high. That's part of the story. And again, this is just looking at the Russell 2000, but even within some of the larger names, you're seeing quite a bit of differentiation from some of the top performing charts and some of the struggling charts just in that little window of the last 6 weeks, how quickly that spread has become, I think, a little more magnified. I want to go to just a couple more charts that illustrate some of the breadth conditions. Sort of on the red flag alert is this measure of breadth. This is the percent of stocks above their 200-day moving average, sort of plunging down from above 50. We were up to around 60% in mid-April. Now in mid-May, we're down almost near to 40%. And a lot of that, again, came off during the day today as a number of stocks sort of broke down their own, below their own 200-day moving average. We're now down to around 40% of the S&P members above their 50-day moving average. I would argue if you think about what would cause the S&P to break down further below 4,100, below the 50-day, and further deteriorate, these breadth indicators, of course, would have to not go up and would have to continue to go down. We're sort of right at that point where these charts start to look much more similar to a bear market phase. We're right at that point where I would start to put a big red check mark next to this one for sure. I want to show you one other just comparison between the S&P and the NASDAQ. And we're going to do that with the bullish percent indexes. I'm going to look at the measure of breadth here very quickly. And one of the bullish percent index, of course, is a breadth indicator based on point and figure charts. If we look at the S&P bullish percent index, this shows you the percent of S&P stocks in a bullish point and figure condition. Right now, it's almost exactly at 50%, telling you it's a coin flip between bullish and bearish charts. Look at the NASDAQ's bullish percent index. This is the NASDAQ 100. So obviously focusing on those mega cap tech communication kind of names. Look at the uptrend we've seen just in the last 3 weeks versus the flat to down rating we've seen in the S&P's bullish percent. What that tells you is sort of the not just tech and consumer, but these other areas of the market. Prices starting to deteriorate, not to warning levels, but certainly not getting better. The NASDAQ 100 all of a sudden starting to show more and more strength. Further, I guess, pressing that bet of strong tech, strong communication, weaker other areas of the market. Let's take a quick commercial break. We'll be chatting with Danielle Shay of Simpler Trading here in the studio. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller at StockCharts.com. We so appreciate you joining us every weekday after the close for our show. A couple quick announcements before we bring on today's guest. Danielle Shay. First off, we welcome your questions. We'll do a Final Bar mailbag on Friday's show, and we love to answer one of your questions live on the air. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV, and we're on YouTube. Just put a comment below the video you're watching on our Stock Charts YouTube channel. We'd love to hear from you. Hope to get your questions, and we'll hope to answer it live on the air on Friday's show. Just to let you know about the upcoming guests, we have a great guest here in the studio. I'll talk with Danielle Shay here in a few moments. Tomorrow on Wednesday the 17th, Jesse Felder, editor of the Felder Report, is going to be coming to us from Arizona. On Thursday, the 18th, we have Jeff Hirsch, Mr. Seasonality. His father, Yale Hirsch, created the Stock Trader's Almanac. He's really popularized a lot of the seasonal tendencies that we assume are sort of an understood thing. Jeff's father, Yale, created it. Jeff has continued and taken on the helm. We'll talk to him live on the show on Thursday. Next week, by the way, on Tuesday the 23rd, we have Doug Bush of ChartSmarter coming to us from Brooklyn, New York. I want to welcome on today's guest, Danielle Shay. Danielle's the Vice President of Options at Simpler Trading, usually coming to us from Austin, Texas. Today here in Redmond, Washington. It's so good to have you in the studio.
Thank you. I love your show, and it's great being here.
No, I appreciate it. You've been a guest on the show before. This is a whole different, our relationship is at a new level now with you in the studio, and I really appreciate you coming in on your trip to this area. Let's get to some of the charts here. We sort of had this uncertain, choppy, people have called it a choppy, sloppy environment. And the question is, where do you find opportunities? We have some of your charts looking at the consumer space, starting with an earnings name, Home Depot. Let's start there and talk us through what you're seeing.
Yes, of course. So, the market is very choppy right now. But for me personally, I really like to focus on earnings because we have a lot of volatility in this space. And with the earnings calendar, you're really able to identify big moves. And so when we look at Home Depot, this is an example of a company that has reported earnings this morning before the bell. Home Depot's down right now, and you can see that it's sitting on a key area of price support. So whenever you have a company that comes out, disappoints on earnings, especially a company that's very critical in this space, oftentimes if it breaks a price support ledge like that, you can get a post-earnings momentum trade.
Interesting, right. And this is one of those names that's gapped lower. Home Depot is a huge weight in the XLY. We'll get to that in a little bit because I want to talk a little bit about consumer discretionary, what the impact of it is overall. But an interesting setup, right? I'm testing support here after the gap lower. What about Target, some of the big box retailers which have come up as well? What's the take there?
So when you look at Target over the course of the past 4 quarters has had a really rough time on earnings. 3 out of 4 quarters, you've seen it fall and just continue falling because people are spending less money and they're also adjusting what they're purchasing as well. And so that's something that I really like to pay attention to when it comes to earnings reports. I like to pay attention to what the executives say consumers are actually going out there and purchasing, because they may be going to Target, but they're not buying TVs, right? So the money that's coming in is lower. When you look at a Target chart right here, Target is also hanging out around a key area of support, and you have those moving averages right above price, quite a bit of resistance there. And so, Target would really need to have a pretty good surprise for it to be able to break up above those resistance zones. And I mean, in this environment, based on the way that it's traded the last few quarters.
I don't know if I'm feeling that sort of move, right?
Exactly. Yeah. And so I like to look at charts like this, especially, you can do it before earnings or you can do it after. Obviously, if you want to get in a trade that's before earnings, you have to deal with the binary event where, hey, maybe they do have some sort of surprise, but that's also the only way to get into a trade before the report, obviously.
Can you talk a little bit more about that? Because obviously we're sort of wrapping up the second quarter of earnings, but I know a lot of people have are concerned about how do you trade around that. So from you thinking a little more shorter term and looking at the options market, what are the things you need to keep in mind if you are approaching a name like a Home Depot going into an earnings release? What kind of things should you be thinking about?
So certainly the number one thing is going to be risk and risk appetite, because, I mean, for me, I am a shorter term options trader, but I also do hold long-term investments as well.
Right.
And so when I look at it from a short-term options perspective, I mean, you have to understand that we can look at the stats and everything, but it is a binary event. So you want to make sure that you have your risk in check. In the options market, generally, we tell our traders to have about 1% to 2% of your options account at risk on an individual earnings trade.
Yeah.
And then, of course, for my stocks, I'm still going to hold them long term, just regardless of if I think it's a shorter term move lower. So typically, keep your risk in check. But in the options market, there's a lot of things that you can do as it relates to earnings, specifically selling premium, because that's a strategy that works really well around earnings reports.
Yeah, at the one of the money shows where you and I actually first met, I remember having dinner with you, which I'm glad we did. I remember chatting with Price Headley, who's also in the option space, and he mentioned if you can't sleep at night, your position size is too big.
Yes.
So I think you hit on that same point, right? Keep it to 1% to 2%, and you've limited your risk at least for each individual position.
Yes.
Let's talk about the broader implication of some of these earnings. Home Depot, the chart of Target, what that means for the XLY, the consumer discretionary sector.
So when you're looking at what's happening to the consumer, that's something that is going to become even more evident over the course of the next 2 weeks as a lot of these companies come out and report earnings. And so when we look at XLY, I wanted to look at the longer term chart here because, we have to remember that in the short term, yes, the market has improved. We've seen XLY trade higher. We've seen a lot of these discretionary stocks doing reasonably well. But on the weekly chart, there is so much overhead resistance. And if you look at this chart, you're right below that $150 price point. You have the January, February highs that are also a pretty critical area of resistance. And then we also have the August highs as well. When you compare an XLY chart to, for example, Microsoft, you're going to see that technology stocks have broken through their August highs. They've broken through their January highs, but not discretionary. And with this amount of resistance plus earnings coming up, This is likely a space that's going to head lower in the short term.
Can we just take a moment, because I meant to mention, this is a weekly chart, as you mentioned, for the XOY. Thanks for pointing that out. The TTM Squeeze is an indicator I know you use regularly. We have it on the bottom of your charts. For those that aren't familiar with what that's telling you, can you just give us like the quick 30-second primer? What is this telling us, and why do we follow it?
So the primary reason why I use the squeeze is because it identifies consolidation that's ready to break out. And so for me, as a directional trader, I want to identify charts that are consolidating that are going to make a move. So I want to use the squeeze for that purpose. And then it also has a momentum bar, which demonstrates if the momentum's going higher or lower. And with that blue bar, you can see how it was light blue, momentum was shifting up, but now the momentum has started shifting lower, and we have those dark blue bars. What that means is that this ticker has lost momentum, and it's now shifting back down to the downside.
Interesting. I feel like we're probably seeing a lot more dark blue every day these days as things are rotating lower. We'll have to see. Your final name we wanted to talk about was Walmart. We're starting with a daily chart of Walmart. Talk us through this one and how it relates to some of the other charts.
So I wanted to talk about Walmart because, yes, there's a lot of negativity out there and the macroeconomic situation is deteriorating, but there are still bullish charts, and Walmart is one of them.
Yeah.
So if you look at Walmart, Walmart has been in consolidation. It's right around that $150 price point, which is why we have a squeeze. When you have a squeeze, again, it's identifying momentum, it's building up, and it could break out. Now, Walmart, over the course of the last 4 quarters, has done very well on earnings, even though, they have noted that consumers are buying less of the high-value items. We also have a lot more consumers, even higher-earning consumers, that are spending more money at Walmart, and they're buying more, Walmart-specific goods. So while the other ones, I think we're going to see a little bit more weakness, I do still really like Walmart stock, and specifically, I like it up into about 155, where we do have a nice price target and a lot of resistance as well. Yeah,
let's go to the weekly chart, because we were talking before we went live about that confluence or that resistance area. The weekly chart really magnifies that. Talk us through this one if you could.
So when you're looking at the weekly chart, you can get a really nice view of how well Walmart has recovered, but at the same time, you can also see the resistance up there at the 155 price point. So for me, when I look at this, yes, I do own Walmart shares. I'm definitely going to keep holding them in the longer term, but as an options trader as well, I see a zone like that, and to me, that is just a great target for an options trade. In the options market, you really do need to have specific price targets. And for something like that, for an earnings trade, that will allow me a nice space where I could sell some premium. I could put a bullish butterfly on, any number of things for the Walmart earnings report.
It's so interesting. I think you've taught me a way to compare trend followers like myself to more options traders, because you tend to have a laser focus on price levels, and I tend to not really know what the price level is because I'm looking more at the shape of the trend. But that's really helpful how that it has to be part of your thought process, certainly when you're thinking about strikes and all of that. Going back to the daily chart of Walmart, if we could, I'd asked you before we went live about just a flat squeeze and what that represents. That represents sort of that consolidation phase, I believe, right? And what does that mean? Yes,
that's correct. So when you look at the momentum bar, and you can see how, it's red if you go all the way back to last year, or sorry, not last year, but March of this year, when you have the momentum shifting lower. Yeah, you see right there, a little bit after that. So oftentimes the momentum will shift lower, but then it will slingshot higher. And you can see how it shifted lower, then slingshot higher. That's really when you want to be in the trade. And so as the momentum has come down, do you see on the chart where you have those light blue momentum bars? They've come down to dark blue, and now it's in this consolidation phase. That's where it's ready to take off. Right. So, for me as a shorter term momentum trader, I want to identify charts that look like that. People will say, oh, the market's not moving and it's so choppy, and that's exactly what I'm out for, because I want to identify those moments where that energy is building up so that I can get in, so that I'm in, before it takes off.
We only have about 30 seconds, but we have to ask about sort of the big name within consumer discretionary, Amazon. Sort of the outlier. I think it looks different than most of the other charts we've talked about, but certainly has been showing quite a bit of strength. Is there, what do you see when you're looking at the chart of Amazon? Is this a still hold it and continue to ride higher, or do you see a cause for concern on a chart like this?
So I've actually been trading Amazon because Amazon had a squeeze. So if you look at those red dots right there, it had gone in and out of the squeeze a few times, but that's one, and Google as well, that I was buying specifically because it had the squeeze and it was breaking out. Now at this point, it has made, my short-term price targets. I was targeting about $115, $118 on it. And so I did take shorter-term profits on that one last week. But I'm still buying shares because I love the weekly chart. I think that it's made a really nice reversal. Both that and Google, I think, we're really shifting as far as a longer-term trend is concerned.
Feels like in a sea of challenge charts, Amazon's sort of an outlier among with some of the others we've talked about. Danielle, what a pleasure to have you in the studio. Thanks for sharing some of your charts with us and sharing some perspective as well. Thanks for coming in today.
Thanks for having me. It was amazing.
That's Danielle Shay. Danielle's the Vice President of Options at Simpler Trading from Austin, Texas, joining us here live in the studio in Redmond, Washington. We've got to wrap the show, folks, and go to the 3 and 3. Let's talk about 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. It's so interesting. I'm thinking of all the different ways to think about small caps versus large caps, some of these different patterns that we've been talking about without looking at the ticker. Does this look like a strong chart or a weak chart? Think about it. Look at the level that we're at. What would a break above this resistance level mean? If you think it's encouraging, I think it is, right? Above an ascending 50-day moving average, very close to breaking out after making a higher low, maybe a cup and handle type of pattern, sort of here, very close to breakout. This is the short Russell 2000 ETF. This is the challenge I have when I think about downside risk for equities. Some of these inverse ETFs really close to breaking out, particularly in the small cap space. It's sort of the inverse of the chart we showed earlier with the Russell 2000 very clearly diverging from the large cap space. I certainly would, I'm a fan of charts like Amazon and Alphabet and Microsoft and others and Meta doing well, and I would say continue to be with those charts that are working at any given moment. However, how optimistic do we want to be when small caps are very, very close, on the verge of breaking down, which is what that inverse ETF is sort of showing. Chart number 2, I didn't get to talk about semiconductors with my guest today, Danielle Shay, but we did talk earlier about the semiconductor space. What strikes me about the chart of the SMH is just this clear pattern of higher lows. I always go back to sort of Charles Dow Trend 101, right? Is this chart going up or not? And when I look and I take a step back from the monitor, I'm seeing a pattern of higher highs. I'm seeing a pattern of higher lows. As long as that pattern continues, why not follow this trend higher? What's interesting is semiconductors actually pulled back a little bit from the end of March into sort of mid-late April, starting to rotate higher here in May. We have some earnings in here. We have charts like AMD, which certainly could be some interesting ones to watch. I'd like to see if the momentum, if the RSI can continue to improve from here. But overall, you're seeing the relative strength start to turn higher as well. And as I've often said, it's always a good time to own good charts. Finally, let's talk about gold. The GLD has certainly been one of the stronger places to be year to date. Going back to the October lows, how impressive of a run for gold, with gold actually testing $2,000 a share, actually breaking above it. There was a headline earlier, I think on Market Watch today, saying for the first time in 2 weeks, gold was trading below $2,000 an ounce. Talk about a fascinating headline that captures the strength that we've seen in something like gold up until now. It's pulling back a little bit. For now, the GLD is still above an ascending 50-day moving average. I see it still holding a potential support level, which comes from resistance that we saw at the beginning of February. Bearish momentum trend, which is something as a cause for concern. I'm sort of have this on a red flag list to see if we break down. But for now, strong dollar in the short term has meant weaker gold prices, and that's what we're seeing. Folks, that's a wrap for today and a wrap for the show. I want to thank Danielle Shay of Simpler Trading joining us here in the studio in Redmond, Washington, and sharing some thoughts and chart with us. For Stock Charts in Redmond, Washington, I'm Dave Keller. Have a great night. We'll see you tomorrow.